All right, day 11, section 3. So made the main point in the previous section that the Fed does not control the money supply perfectly. They control the monetary base and can use the monetary base to influence the money supply. But the reason the Fed doesn't perfectly control the money supply is because they don't control the money multiplier. Specifically, they don't control how much currency the public holds and how much excess reserves. And at times, the public will greatly change the amount of excess reserves or currency that they hold, in part because of financial risk, right? During periods of great risk, people tend to want to hoard cash, and they tend not to put their money in banks. And so if we actually look at a couple of examples from history, we can see this happening here. So let's look at what happened during 2008. We've talked about quantitative easing. This was when the Fed greatly expanded the monetary base by not just buying treasury bills, but by buying mortgage-backed securities and treasury bonds, right? And so if you look at this figure here, we can see that the Fed really, pull this up, the Fed really expanded the monetary base. But look how this big increase in the monetary base only didn't have really a great deal of effect on M1, right? M1 was growing, but it didn't blow up, right? And specifically, if you look at this period here, the monetary base increased dramatically, but the money supply really changed very, very little. What does this tell us? It tells us the multiplier must have fallen dramatically, right? It must have fallen dramatically. Why? Well, most likely, not even most likely, we're going to see this is what happened because of risk. When risk went up, people held more currency and banks held more excess reserves. They were precautionary, right? People held currency because they were just afraid of putting their money in the banks, right? They were afraid of losing their money. A lot of people cashed out of stock markets, and they didn't want to buy more financial assets, so they just held cash. And banks were reluctant to lend. And so instead of lending, they credit rationed, and that led to a big credit crunch. There was also, and we're going to talk about this more a little bit tomorrow, some important changes in the Fed's operating procedures, in which the Fed began to pay interest rates to banks who held excess reserves. And that also greatly influenced the amount of excess reserves in the banking system. So you put that together, and here you can see what happened to the currency ratio, right? Where currency didn't really change that much, honestly. Now that I look at this, you know that the thing is there had been a long downward trend in the currency to deposit ratio. So I guess maybe what you could say is that this downward trend kind of abated for a while, right? It kind of lessened. But the much bigger change was in the excess reserve ratio. Look how much that jumped, right? Where banks are holding almost no excess reserves, to holding, right, huge amount of excess reserves. And that significantly lowered the money multiplier. So this problem that the money multiplier tends to fall during periods of high risk and periods of economic risk is what Keynes called the liquidity trap, right? When interest rates go down to zero and the money multiplier falls, how does the Fed increase the money supply? It's hard, because if the Fed tries to increase the money supply, all people do is hold currency, and all banks do is hold excess reserves. It doesn't lead to a lot of lending and deposit creation, right? And so this is why the Fed tried to do other things, right? Instead of just trying to work through the traditional monetary policy of getting banks to lend, they did other things, such as they were the lender of last resort to markets, right? This is one of the reasons the Fed bought mortgage-backed securities. Is they said, listen, if we can't increase the money supply, the least we can do is try to stabilize prices in some of these markets that are crashing. Quantitative easing, right? The Fed tried to buy long-term government bonds and tried to reduce long-term interest rates a little bit. So they said, listen, if short-term interest rates are down to zero, let's see if we can put downward pressure on long-term interest rates. And so what the Fed essentially did was that they increased their balance sheet by about 400 times. I'm just 4 times, right? 400%. The Fed created a huge amount of liabilities in terms of currency and reserves. And they used these to buy assets, right? And so it led to a huge increase in the monetary base. Now, many critics at the time said, what about inflation? The Fed can't do this. The Fed's just printing money. Inflation, 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 inflation. What the Fed understood was that during a downturn, the Fed has a lot more leeway of increasing the monetary base because the money multiplier is so low, right? And this same thing is happening right now, right? The Fed is increasing the monetary base quite rapidly. I'm sorry I don't have better information for you on how this information usually only comes out with a lag. And so most of the information I've seen is not really particularly reliable, but we know from practice that the Fed is greatly reducing or greatly increasing the monetary base. Does that mean we're going to have a big increase in inflation in the future? No, very unlikely, because we also know that the money multiplier has almost certainly fallen, right? Almost certainly fallen. These changes in the Fed doing quantitative easing and kind of always focusing on the financial sector and always focusing on banks, always focusing on bond markets, has received a lot of complaint from critics, right? And they say, you know, the Fed is always out there trying to bail out big financial interests and never trying to bail out individuals. And well, I don't know if I personally completely agree with that criticism, because I think, you know, unfortunately, we are all tied together, whether we like it or not. Our well-being as individuals is very closely tied to the performance of these big financial institutions. But that said, I think it is a legitimate question about whether the Fed can do more to help individuals directly. One of the ideas that some economists have tossed around, and this is in the handouts I've given you, is why doesn't the Fed think about creating a bank account for everybody in the United States? And during a downturn, why couldn't the Fed print up money and put money in those bank accounts, right? So instead of just using fiscal policy and borrowing the money, why doesn't the Fed just print up money, right? Instead of buying bonds with it, why don't they just essentially allocate the money to individuals? It's an interesting idea. It really is an interesting idea. It would be kind of another way of trying to provide stimulus spending and maybe more directly, right? So particularly, it's a really interesting idea for the current pandemic, where this current pandemic is so closely tied to what's happening with individuals and demand, right? Because we can't shop, because we're all kind of fearful, we're not spending. You know, people, we've seen this huge increase in unemployment, right, of about 10 million Americans. So those people are obviously very scared about, you know, where they're going to get future income. They're not spending, right? Because the very nature of this current crisis was not initiated in the financial system. It seems weird that the Fed's always first response is, well, let's help the banks, right? This crisis wasn't started by the banks, and it's not clear that it can be saved by the banks. So should there be a role of monetary policy in distributing money directly to individuals? It's an interesting idea. It really is an interesting idea. I'm not sure technically that it's legal. That's the first problem, is that I think that this would have to be approved by the president and Congress, right? Because I'm not sure, if you actually look at the charter of the Fed, that the Fed can just open up bank accounts for every American and give them money, right? But, you know, as I said, it's an interesting idea, and it's a way of thinking about monetary policy, right? Right. The idea that the Fed doesn't necessarily, you know, let me back up here. In 2008, the Fed tried a lot of different things to try to respond to the nature of that crisis. So I think the question is, should the Fed be thinking about trying different things to respond to this crisis? And I think the longer that this crisis goes on, the more that the Fed really has to be thinking about some of these outside the box approaches to running monetary policy. Okay, that's it for chapter 14. I told you it's kind of a short chapter. So that's it for day 11. Remember that your homework number 3 is due on day 12. All the best. We will see you tomorrow, and we'll be talking more about determinants of the money supply in chapter 15.